Welcome to our offices. Thank you for joining us today for full year results of 2015 presentation. As you can see, the presentation will be given by Mr. Marek Woszczyk, CEO and the President of the Board, CFO Magda Bartoś. As always, we'll give the presentation and later on we'll be available for your questions.
Okay. So we shall start, I guess.
Yes, please.
A kind of a routine job that we do every quarter. This time, yes, good morning, everybody. Thank you very much for coming to join us on the PGE annual report and presentation conference. As usual, I will give you an overview of our annual performance with some background comments on the macro environment and regulations that potentially could impact our business. And further, I will take you through our latest development in terms of our investment program across all PGE segments as we spared no efforts, I could say, to deliver all the milestones according to the schedule and the budget. Then, as usual, I will hand over to Magda, our CFO, to get you through some more detailed information on our financials. And of course, later on, we will be available to answer all of your questions. At the beginning, the honeycomb of our results. So last year, full year results that we published yesterday evening confirm, I think, sound financial and operational performance of our company, despite the shifting market conditions. So operating results of all segments were very good, which allowed for EBITDA of over 8 billion and 200 million zloty, which is the highest EBITDA level in the PGE history. Net cash generated from operations is pretty strong, I believe, because it amounted to 6.8 billion zloty. Of course, at the bottom line, for the first time in the history of the PGE, we recorded a loss of 3 billion zloty, however, adjusted by the level of impairments of assets that we made in the half of the past year. Dividend-based profit amounted to almost 4 billion and 300 million zloty. Just to recall you, impairment resulted from a changing environment on commodities market, and I mean in particular hard coal market and climate change policies, mostly prospects of carbon allowances. Our generation and the distribution assets were at high level of operating performance, so net generation increased by 1%, while distribution volume was up by 3%. Supply volumes were also comparable to last year's and were 2% down. The year of 2015 was a year of relatively heavy capex spendings. PGE investments heavily relied on conventional generation. We have reached advancement of over 1/3 in Opole and secured technology update in Turów project with respect to new environmental regulations. We've also expanded our renewables fleet with 4 new wind farms of total 218 megawatts of installed capacity, so we delivered what we promised within our strategy. Last but not least, we have invested over 1.8 billion zloty in our networks, extending the length of our lines and improving the quality of the dispatch. This all goes about money, so we have secured financing for a large part of our investment plan with 3 most important agreements. Just to mention this, firstly, syndicated loan of total 5.5 billion zloty value at very competitive conditions. Secondly, European Investment Bank loan of 2 billion zloty, mostly targeted at network investments. And thirdly, we have also extended our BGK loan with further 500 million zloty. in terms of the macro environment, you know that the GDP growth of Poland, Polish economy continues to be at a very healthy level, and it seems to stand out across Europe. So 3.6% growth in the whole 2015 and close to 4% in standalone fourth quarter of the last year translated into very healthy growth of electricity demand at 1.7% and 1% respectively. However, market perspective does not look at all that bright. It seems to be visible that we are experiencing a bit weakening electricity prices looking forward. When looking at 1 year forward base contract, so average price in 2014 was 168 zloty, while in 2015 it was 164 zlotys, so 4 zlotys lower, 2%. What we could roughly transpose to change of our estimated 2016 realized blended price. Market predictions for 2017 are even less optimistic, with average base year contract at the level of 160 zlotys since the beginning of the year. One of the drivers behind is, we believe, international trade. Although our country was last year net exporter of electricity, we are still net importer of 2 terawatt hours if to look at trading volumes only. So something that we can expect this year is more import due to the launch of Sweden-Lithuania connection, finally tested these days and opened for commercial trading. Another supply factor is huge increase in wind capacities and wind generation, already remarkable in share of wind in total generation in Poland, rising from 7% in December 2014 to 11% in a comparable month of 2015. So this is something meaningful, I believe, for the market. Of course, PGE, with its 529 megawatt of installed capacity in onshore wind, is greatly contributing, as we would like to be visibly present on the source of that type of electricity as well. But it doesn't change the perspective of the total overall energy mix in the coming years. Altogether, it was only German market, just to compare the Polish situation to the other countries, neighboring markets especially, it was the only German market that had more wind capacities added to the system last year across the whole Europe. One important factor, because in December the Parliament has decided to make an amendment to the adopted during the last year renewable law, just to postpone its enter into vigor by the 6 months. So it happened to us that, with an overall 5.3 gigawatts of installed capacity in wind, roughly 300 megawatts has just appeared during the very recent period by the end of December. So normally we could expect that those 300 of megawatts of the wind farms would not appear if renewable law would enter into vigor as planned originally. Regulatory update. So last year was again very rich in regulatory changes. First of all, I mentioned renewables law was amended, effectively postponing the launch of new capacities auctioning to July this year. Some further adjustment in the law are still probable, and we will keep you, of course, informed on potential changes that could somehow affect our operations. In terms of the distribution, during Q3 last year conference, we were discussing a proposed new model for the distribution remuneration as proposed by the regulator. Since then, some amendments were introduced that should work to favor of network operators. Those provide for slightly improved return on investments in grid and, as a result, secure network reliability that is essential for the Polish power system and for customers in particular. In terms of the generation, when talking about the reliability of the whole system, the capacity mechanisms are not to be ignored. The overall budget of operational capacity reserve was increased and amendment to allow full budget utilization, contrary to the last year. So finally, another element of so-called capacity market in Poland, I mean interventional cold reserve, is in operation since the beginning of this year, including 2-hour units in Dolna Odra power plant. Nevertheless, we should rather treat those two mechanisms, so operational capacity reserve and cold reserve, as a transitional, while accelerating discussion regarding full capacity market in Poland. Hopefully, we see some positive signals coming from the administration level about that idea. Of course, its importance increases since the coupling of capacity required from volumes produced from sources of lower reliability is more and more evident. As a country, we are still challenging the decision regarding market stability reserve, and we are doubtful about the bad conclusions. In terms of investments, currently, we are focusing on 3 most important projects: 2 hard coal-fired units in a power plant, you know it, 1 lignite unit in Turów, and of course gas cogeneration unit in Gorzów. We call it the flagship projects of PGE. So let me stop a little bit on the Opole project, which is the biggest one among our investment and obviously the most capex intensive. Opole was progressing very well in the last year and still is moving forward in line with the adopted schedule. Last year we spent almost 2.7 billion zloty on this project. Total outlay from the beginning of this project amounted to 3.3 billion zloty. At the end of the passing year, just to recall you, the overall budget is on 11 billion. Looking at already reached milestones of that project, we can expect the commissioning of Unit 5 in the second half of 2018 and the Unit 6 in the first half of 2019, so according to the plan. As I have mentioned, works on Opole are progressing well, in line with adopted plan and on budget, reaching this month 35% of progress. Civil and construction works within both units, 5 and 6, are in full swing, if I may call it, meeting all the scheduled milestones. We've just completed the shell of the cooling tower for Unit 5. Currently, we're continuing the assembly of the steel structure for boilers and turbine hull of both units. So I think that size of works is pretty impressive, but there is still a lot of work ahead. As I mentioned, 35% of advancement of the project. Among others, both units will get the complete turbine hulls, steel structure and cooling water systems this year. So you can follow, of course, the progress of the overall Opole project investment on the web page if you want to stay updated with that investment. Turning to our modernizations pipeline of generation assets, we are currently focusing on 2 types of investment. Firstly, refurbishment, aiming at extending lifetime and efficiency of our units. Secondly, projects aiming at reducing sulfur and nitrogen emissions. In this area of refurbishment of existing units, we are at the final stage of works in Bełchatów. This huge project is expected to be finalized in May this year. So we've just synchronized Unit 9 with National Power Grid over 1 week ahead of the schedule. Within this project, there is only Unit 10 still under modernization phase. Just to remind you, the project's objective is firstly extending the lifetime of the unit up to 320,000 hours, which enables utilization of existing lignite resources close to Bełchatów. Secondly, boosting the efficiency of the unit approximately by 2% high, 2 percentage points high, of course. And thirdly, increasing of achievable power capacity of each unit from 370 megawatts up to 390 megawatts. In Turów, we will start the modernization of units 1, 2, and 3. In this case, we have already signed contracts for turbine, island, electric, generator, turbo set, as well as automation control instruments and measurement equipment. Parallelly to it, proceedings for modernization of the cooling towers is pending. So all contracts for the whole project are expected to be signed by the end of this quarter. And we expect to complete the project in 2020. There are 3 main objectives of this project. Firstly, as in terms of Bełchatów, extension of the lifetime. But in this case, we want to add some, we want to reach the level of the lifetime of, in total, 150,000 of hours. Of course, we want to increase the efficiency of the units by almost 3 percentage points and increase the power capacity of each unit from the existing 235 megawatts up to 250 megawatts. Switching to projects aiming at reducing sulfur and nitrogen emissions, we are operating in this subject in few locations. I think it's worth outlining some of them. Mainly these projects that are expected to be completed this year. So Bełchatów, of course, and Turów, both with SOX installations meeting the requirements of binding EID directive, and Opole units with NOx installations meeting the requirements of the same directive as well. In terms of renewables, the last year was a really extraordinary year in the renewables. A large number of projects were pursued across Poland to commission new capacities before year's end, so to lock within the existing support scheme. Proudly, we can confirm, someone is calling me intensively, sorry for that. Proudly, we can confirm that we successfully delivered 4 wind farms on time and hopefully significantly below the initial budgets, with as low as 4.8 million capex per 1 megawatt in Resco wind farm, as while total capex for these all projects amounted to 1.2 billion zlotys. So average was 5.5 million per 1 megawatt of brand new installed capacity. So total of 218 megawatts were built, and therefore we almost doubled our wind capacity, which made us a leader in onshore operational capacities in Poland as we planned under our strategy. As I have mentioned during the Q3 results conference, there is still some uncertainty related to the RES support as of beginning of this year. So nothing has changed. I mean, in particular, the final auction timeframe, as well as price and volume to be purchased. So decision on our participation will be based on thorough analysis of the market environment and particular project risk. Distribution. We've also carried out intensive works aiming at improvement of the quality of supply, because we know today precisely what we can expect from the new regulatory model. As you can see, the capex for modernizations and expansion of our grid in last year exceeded 1.8 billion zloty. As last year, we focused mainly on reliability of supply through reducing the length of interruptions. Throughout the whole year, we reduced the duration of unplanned electricity outages by 7%, despite some adverse weather conditions affecting our grid. Through that CapEx, we constructed more than 1,500 kilometers of distribution lines, and almost 3,000 kilometers were subject to a substantial modernization. In terms of new customers, new off-takers connections, we have closed last year with over 60,000 completed connections agreements. Not surprisingly, the largest investment projects were carried out in Mazovia region, when we have spent nearly 400 million zlotys on the new infrastructure, mainly grid transformers and new connections. Now it's up to Magda to take you through some details on the financials.
Thank you, Marek. Good morning, everyone. Thank you for joining us today to discuss the PGE fiscal's results. As usually, at first, I will present you with a summary of our financials and operations, followed by CapEx details and outlook for 2016. 2015, as Marek already mentioned, was another strong year for PGE. We delivered on our strategic priorities in terms of both financial results and operational improvement. Now I'll turn to a more detailed review of our key financial metrics, both for the fourth quarter and 2015 in full. The fourth quarter reported revenues reached 7.4 billion Polish zloty, up by 1% versus last year. For the full year, our top line was 28.5 billion, slightly increased versus last year. However, please bear in mind that our last year's sales were inflated by 1 billion of adjustment to long-term contracts final compensation. Excluding that one-off, our revenues grew by more than 5%. That is exactly in line with wholesale electricity price uplift. Our Q4 EBITDA grew by 40% to almost 2 billion, reflecting favorable markets, in particular that higher wholesale electricity prices. That was another strong quarter this year that supported our full-year EBITDA. On a reported basis, the group's EBITDA reached 8.2 billion, well within the strategic target. On a like-for-like basis, our annual EBITDA came at 7.5 billion and grew strong double-digit compared to last year, as we benefited from higher wholesale electricity prices and extended retail margins. Also, our bottom line for the year, on an impairment-neutral basis, looks solid, with adjusted EPS at 2.29, up by 14% versus last year. Our reported net earnings for 2015 came at a loss of 3 billion, hit by extraordinary asset impairment charge, that is 7.3 billion, including tax effects, reflecting anticipated deterioration in the general market and business environment, in particular fossil fuels, pricing trends, CO2 burden, and expanding renewables capacities. Having that in mind, we are extremely focused on cash flows. Our operating cash flow for 2015 came at 6.8 billion. That is an increase of 7% versus last year. The strong cash flow we generate and modest leverage allows us to consistently invest, that Marek already guided you through, to transform our asset base. We saw some selected projects, but on a total amount, our investment spend for the year amounted to 9.5 billion, up by almost 50% versus last year. The fourth quarter itself hit a record 3.6 billion of the CapEx outlays, testing well our team's managerial and coordination skills. We invested more into new projects this year, more than modernizations, that is for the first time. Our top priority in the use of cash will remain investing in our business, reinvesting in our business, while also returning to shareholders. Please note, in 2015, we adjusted our dividend policy that is to allow us to ignore the non-cash impairment charges when computing group net earnings for the purposes of profit sharing. And now when it comes to, let's take a look at our generation volumes. Our Q4 lignite production reached 9.25 terawatt hours, down by 7%, reflective of the continued overhauls at Bełchatów plant, where units 9 and 10 were outaged. Hard coal production came flat for the quarter. For the full year, our total production volumes increased by 1% and reached 55.58 terawatt hours. We saw lignite production flat to last year at 38.6 terawatt hours, and hard coal production slightly lower, that is down by 1%, as our load factors were lower and more time of the units was devoted to operational reserve. Those were largely offset with better performance of our hard coal-fired CHPs. In the gas cogeneration, we almost doubled our production volumes, fueled by support reinstatement that was in place for the full year last year. As we executed against our growth strategy in offshore wind, our new capacity added to the fleet throughout the year allowed to generate 28% more of the production output. Wind generation was also supported by favorable weather conditions, contrary to hydro, where outputs dropped as we experienced an exceptionally dry year. Generation and distribution asset performance is at the top of our agenda, and both segments delivered another year of operational improvements. In terms of generation assets, availability delivered was higher than last year across every conventional generation technology at close to or above 85%, with significant improvement made by hard coal-fired power plants, as no major overhauls were performed there last year. Load factors for both lignite and hard coal dropped versus last year, as roughly 4,700 hours were added to operational reserve and less capacity was used by the operator, by the TSO. That effect was largely offset, as said, by higher load factors at our CHPs. Our wind generation assets noted a very successful year, with peak performance both in terms of availability and load factors that came at almost 29%, up by close to 5 percentage points. Our wind farms, all of our wind farms delivered double-digit growth in production last year. As we've shown in previous quarters, our commitment to increase reliability of electricity supply to distribution customers is key and remains strong. We improved in every metrics, in particular reducing SAIFI by 7%, and that is indeed despite of heavy storms in July that affected our SAIDI by roughly 40-50 minutes. SAIFI also improved by 1%, and connection time was shortened by 5%. These are obviously areas we can still do better, and we'll continue to improve on the 3 KPIs as they secure our distribution returns going forward, as communicated in the new regulatory framework. Network losses were reduced significantly, and we kept those below 6% for the second half of 2015. Now let's review our annual EBITDA performance by key value drivers. Our recurring EBITDA for the full year reached 7.5 billion Polish zloty and was more than 1 billion higher than last year. Roughly half of that improvement was driven by higher wholesale electricity prices. An average realized price for 2015 was 173 zloty, 9 zloty more than in 2014, and that added to our conventional generation business line results. Margins in retail market expanded by 240 million, reflecting better spreads in electricity prices sold and procured. Hard coal costs were lower by 47 million as volumes were lower, and prices also dropped by 0.2 zloty per gigajoule. Biomass prices were also lower this year compared to 2014 and allowed for 20 million profitability improvement. CO2 costs remain our major concern and eroded profits as we receive less of free allowances. The gap last year was larger than in previous year by 3.3 million tons, and prices were growing in 2015. Those were lower on average by 2.6 zloty per ton. Sorry, were higher, obviously. Those two effects led to 68 million and 108 million additional costs, respectively. Increased payments received from the transmission system operator added 73 million to our EBITDA, including additional operational reserve remuneration of 39 billion. Those revenues reached 85 million in total for the full year. Renewables support effects represent a mix of factors here. While green certificate prices plummeted for the year, our generation revenues dropped by close to 150 million. That was largely offset by our retail branch reduced costs. However, comparability of data is a bit distorted here, as in 2014 we reversed some excessive provisions of 2013. Cogeneration support came at lower cost for the group by 21 million, fueled by full-year production of Lublin and Rzeszów CHPs. However, still the cogeneration support has a negative effect to the group of 21 million. Increased volumes of distribution electricity, those were 3% higher year over year. Additional connection revenues and efficiency improvements allowed to more than offset the infamous 5% haircut on regulated asset returns, you might recall, and contributed additional 172 million to our group's EBITDA. Lastly, as we exploit our lignite pits, part of the expenditure borne is capitalized and matched with future lignite extraction. The amounts vary according to work schedules, and in 2015, 200 more than last year was carried over to future periods, mainly related to Szczerców field in Bełchatów plant. Segment's contribution to group's EBITDA shows quite a consistent picture with previous quarters. Half of the group's EBITDA for 2015 was delivered by conventional generation business line, as the segment benefited from increased wholesale electricity prices, lower hard coal costs, and reinstated cogeneration support. A solid third of our recurring profits comes from distribution segment. A growth of 2% versus last year is especially worth noting, given the more challenging regulatory environment. Renewables results were hampered by dropping green certificate prices and lower hydro generation. Both negatives were offset by increased wind production. New capacity was added, just to recall it again, and load factors improved, and additional pump storage remuneration. Moving on to CapEx. Our group's total CapEx expenditure for the year reached 9.4 billion, translating to 49% growth versus last year, driven by strong execution against all our strategic priorities. Our conventional generation segment consumed roughly 2/3 of the expenditure, with Opole flagship spend of 2.7 billion last year and refurbishments in Bełchatów of 1 billion. 1.8 billion was invested in our distribution business, out of which 1 billion represents modernization and roughly 800 expansion of our customers' base. Renewables business delivered exactly what we promised, and 4 new wind farms of 218 megawatts installed capacity were built at a cost of 931 million. PGE delivered a strong result over 2015. However, we all bear in mind the macroeconomic and regulatory environment that will have an impact on our results going forward. That was greatly reflected in the impairment exercise for the half year, and a 9 billion write-off from our conventional generation asset base. As a result, our 2016 outlook obviously reflects the same effects as well. Specifically, we expect two of our segments to deliver substantially lower results next year. That is conventional generation business and supply business. The first one will need to face meaningful impact from lower wholesale electricity prices. Those will get realized in the range of 168-170 zloty per megawatt hour, and production volumes will be lower as well, as both on lignite and hard coal. CO2 continues to increase its burden, as we again will receive approximately 3.5 million tons less of carbon allowances versus the previous year. CO2 prices, even though down at the beginning of 2016, remain a threat, especially with Polish zloty weakening against the euro. All those headwinds will be addressed with enhanced efficiency improvements. We expect supply margins to erode, reflecting market pressure. While we will fight our battles in the electricity market, distribution is also expected to face headwinds in 2016. Changes within the regulatory and business environment are expected to hamper our results by 250 million Polish zloty. Renewables business will enjoy their increased production capacity in wind throughout the full year, and we anticipate the segment's EBITDA to be higher than in 2015. We expect our capex for 2016 to be slightly lower than in the record high to 2015. Opole project will be continued as planned, and roughly 3.5 billion will be spent there. As we expect to enter more capex-intensive period in Turów, especially Unit 11 project, a significant step up in investment expenditure is expected there. Renewables development will be kept rather quiet, and only limited modernization spending will be directed to renewables. Distribution segment is expected to follow their development plans, with capex slightly lower than in 2015. Financing, as said, is secured for 2016, as we made some heavy work last year closing key loan arrangements. Now, as we embark a rather rough 2016, let me thank everyone at PGE for a solid 2015, and thank you, viewers, for joining us last year and for your presence and interest. And I guess, Kuba, we can now open it up for questions.
Thank you very much. Yes, now we'll turn over to our guests in the room. You will have priority in asking these questions. For the sake of the internet viewers, please apply for the microphone to make them hear what you are what the questions are. And for our comfort, please limit your questions to 2 at a time. Of course, follow-ups are more than welcome, but it makes us much easier to answer your questions if they are not in large number at one time. Please, the floor is yours.
Paweł Puchalski, PZWBK. 2 questions. First, on EBITDA outlook. You used words substantially and significantly lower. I would love to listen to your what it means. Is it significantly it's above 10% and substantially is above 30%? How shall I approach substantially and significantly lower?
As with previous quarter, we rather avoid giving numbers, giving very specific numbers, and we comment on the trends and we comment on the key impact factors to our business. And same this year, we rather give you the key specifics, the key metrics that will impact our results. The key important one is the wholesale electricity price that is lower expected, or that we already communicate the range of prices we expect for the full year of 2016. And the math is yours, unfortunately.
I may add to it a little bit because I understand your interest in that question. And as we informed you during the Q3 presentation that we are in the process of reviewing our strategy, so we plan to finalize that project for the obvious reasons in the second quarter of this year. Then we're going to publish our new aspirations, including the economic aspirations, including EBITDA, as you questioning today. Okay, and we'll be more disclosing what we mean by substantially. Today, what we're saying is indeed substantially is definitely something different than negligent.
The other question I heard from the Ministry of Energy that he likes offshore wind. Is there any progress in your project? Has your works on offshore wind project accelerated recently or not?
We are at the very initial stage of that type of investment. What we do, I'm not a professional of that field, but I understand that we do some new site characterization and environmental impact assessment analysis, and we are during the tendering procedure. Actually, at the end of that procedure, so we have potential partners to execute that type of the activity, but that does not mean that we are ready to make a final investment decision today. This is not that stage of that investment, but yes, indeed, we keep our interest in that direction.
The first question is, do you think that Enea, after merging with Bogdanka, might become competitive to your lignite assets in the merit order?
I think that till we can extract the lignite from our open pit mines at a lower cost, basically cheaper than the price of the hard coal extraction is, or the cost of the hard coal extraction is, and this is the situation that we see will continue in the coming years. Then, despite of the fact that the margin or the difference between the costs of extraction of the lignite and the price or cost of extraction of hard coal is lower than it was in the past, then we are not carried too much about our competitive position within the merit order. Okay, of course there are some limitations, and I mean by that CO2 is the factor that we, as almost the only lignite generation producer in this country, have to take into consideration, as this type of technology is more emission intensive. But today's prices of the CO2 are far from the critical level that our analysis shows, in order to change our position in the merit order in terms of the lignite. So we still make money on the lignite. Yeah. So I don't see any critical threat from that.
Yeah, and can you comment on the latest CO2 prices behavior? Because it tend to change the trend since the beginning of 16.
Yeah, maybe a couple of elements could influence or could impact that could have an impact on that phenomenon that we can experience in recent weeks. Actually, I think one of the elements might be there are a couple of them. But one, I think that there is a gap between the backloading period and MSR period. So, as you know, backloading, some 900 million of tons of CO2 allowances that was taken off the market, is valid till the end of this year. And MSR, Market Stability Reserve Mechanism, according to the decision of the Commission, is to be introduced effectively in 2019. So we have at least 2 years of the gap, 2017, 2018, when those 900 of the million tons of the CO2 allowance will be back to the market. bringing about even a higher surplus of the CO2. This is one phenomenon. Second, and the market probably, is reflecting that in the price formation. Secondly, economic slowdown that many European member countries, except for Poland, is experiencing today. So it also, linked to some expectations to have a cheaper gas that was in the past, probably also, eases the tension to buy the CO2 or to hedge the CO2 sooner than later. So it all causes rather lower CO2 prices as the effect of the beginning of this year. Of course, that positive from our perspective, if you take into consideration lignite, especially, right, phenomenon, is amortized, if I may call it like that, by the rate exchange of Polish zlotys versus euro, but still the effect is that we can buy cheaper CO2 today. Will it continue? Is it a phenomenon, durable, stable, substantial, or is it temporary? It's hard to say today. I just mentioned two major factors that I believe could, provide for a lower than higher CO2 prices as we can observe them today. But I wouldn't risk, any critical statement that the situation will continue, that we will, of course, observe lower and lower CO2 prices in the coming months. No one can guarantee.
And is there any update about free CO2 for Polish utilities after 2020?
After 2020? Yeah, we are. It's rather a question to the Polish administration, but I will not hide that, as a Polish Electricity Association president, I'm pretty familiar with the topic. I could say that serious talks continues with the European Commission on that. One element that I mentioned during my presentation is that the Polish government challenged the MSR, Market Stability Reserve decision, to the court. I will not disclose, the elements, the argumentation of that claim, but this is the substantial move that we are critical about, minimizing the compensatory effect from what was discussed and negotiated during the December 2014 European Council summit. I think I try to be very positive, that we will get those free CO2 allowances. Otherwise, it would be an obvious breach of the conclusions of the European Council summit from 2014. And so I don't see any let's say, political possibility that Commission could do something else that was agreed at the level of the governments, actually, because European Council, this is the level of the governments, European Commission. This is not that level.
Question about, can we get some update about how advanced is the OPEX program? Maybe before the strategy?
Yeah, a good question. That refers mainly to the revision or update of our strategy. One element I can disclose today that definitely a revision will concentrate or put more accent, greater accent on efficiency. We have a very extensive investment program, as you know. We say a lot about it, and market conditions is more and more dense, if I may call it, right? So we have to concentrate on looking the value within us. So efficiency, that's what we push on today under the revision of our strategy. More disclosure on it second quarter this year.
Good morning, Grzegorz Witkowski, Insignis. I've got a question about a factor that is probably of a lot more importance than the CO2. I mean, the electricity price. What we observe is steadily going down, the price going down in Europe. The Polish price also tending lower, but still by 40% higher than the European price. And my question is about your view on that. Do you believe that this huge premium can be sustained even given the limited interconnection capacities? Or you would rather expect that the Polish price will over time converge to the European one?
What we observe today is that the prices are converging more and more across Europe as the market is integrating or forced to be integrated. Anyway, but I see it rather in a long run, in the short and mid run. I think that the situation will continue as it is today, so we will be visibly higher in terms of the prices in relation to our neighboring markets and the other markets across Europe. Of course, we also mentioned that, me and Magda, we said that, international trade, we see that more capacity on interconnectors that we have and we will have probably will have some impact on the price formation on a wholesale level in Poland. But when you take into consideration the volumes of the capacity that might be potentially offered by the transmission system operators to the traders, so those volumes are not that high that in order to have a critical impact on the price formation here in Poland. I'd rather see that, Polish energy mix is changing because of the renewables. Just to recall what I already said, in December 2014, 7% of the total generation came from the wind. Last year, December, 11%, so 4 percentage points is rather huge in that quick period of time. And that's the effect mainly, of course, in conjunction with the more and more capacity coming from the Polish-Lithuanian interconnector and Swedish-Lithuanian interconnector, Nordbalt, right, together. Another element, phase shifters installed on Polish-German profile. Of course, they will also allow for some injection of the power coming from the Germany, but on the other hand, all those interconnectors will create the opportunity for us to export some power in times when the relation of the prices between the relevant markets is in favor of that of export of the Polish power to it. At the beginning, just to recall, at the beginning of the operational phase of Polish-Lithuanian interconnector, we were profiting as a PGE. Basically, right? But generally, Polish market profited from that opportunity, and we were exporting pretty much volumes, pretty volumes of the capacity towards Baltic countries, and but I understand your question in the sense that you worry about lower and lower prices in terms of the structure of Polish energy mix, generation assets, etc. And we also see that those prices are not at the levels as we expected 2 years ago, for example. But we are happy to hear from the administration level, even yesterday's presentation of the Mr. Morawiecki reindustrialization plan, and including some elements referred to the electricity market, and that plan mentions explicitly market capacity mechanisms as needed element, as a needed reconstruction, remodeling of the Polish electricity market in order to make our whole economy sustainable. With no electricity, secure electricity will not be able to think about the sustainable economy. So this is a very huge concrete signal that after the years of attempts of the sector on make some change on a Polish electricity market model, there is at last a very concrete, explicit sound that we will find another that we will go towards the capacity market, and.
Think that this is not internally coherent, this plan. If you plan in the reindustrialization of a country, you cannot assume that the Polish companies will pay the electricity price by 30% higher for today and when the new schemes will be introduced, then the premium may even widen. So I know this is good from your perspective, but I think that sooner or later some of the companies, I mean enterprises, will put this question to the agenda, that they are losing their competitiveness against their European peers. So you know, whenever the politicians mix into the economy, we were supposed to have the lowest electricity price in Europe, and what we see is just the opposite. Because of the subsidizing of the coal industry, we have the price that is by 30% higher. So
Yeah,
I just wonder if this is sustainable.
Well, a question of a political nature, of course, we have to find a balance between the interests of the all parties, but I think that entrepreneurs will take into consideration when making their business decision about where to run their business, not only the level of the prices of electricity, but also, let's say, stability of the whole overall system functioning. I would not recommend to install my facility in a country where, with the full of interruptions of the electricity, there's a risk of outages will, impact on my production, and we don't want to be effectively that type of a country. But I understand what you mean. But in the long run, it's just I'm not a fortune teller, okay? But I see what may happen during the next 5 years, for example, because today planning after beyond the horizon of 5 years, I don't see any reasonable politician, businessman, manager, anyone who could responsibly say what we can expect after the 5 years from now. That's it.
Robert Mahajtong, what would be the management recommendation regarding the dividend from 2015 adjusted net profit? And would you wait till publishing the new strategy, or till the required investments in coal industry are needed, or would you come up with your own dividend recommendation before that? And the second thing, you say in the presentation that in 2015 there was 200 million positive impact of capitalized cost of lignite extraction on the EBITDA. Do you expect this effect to prevail in 2016, or rather not, or in what scale? Thank you.
No, in terms of the dividend, I would recommend to be patient till the general meeting will take place. This is a routine job that we do every year, but I can assure you that we want to stay a dividend company. We didn't change our dividend policy in terms of the level of the dividend payout and we want to offer to our shareholders. Absolutely not. Even if we made the impairments in the last year, we corrected our dividend policy in order to stay the dividend company and keep paying the dividends to the shareholders. So don't see any risk, serious risk to it. But explicitly we'll be ready to say some concrete, precise details on the level of the dividends at the general meeting.
When it comes to lignite extraction, those costs are out of the total expenditure that we bear when extracting is specifically overburden. We then capitalize part of that or expense depending on the work schedules, depending on the field of lignite that we will extract this year or the following years. And as such, it is very difficult to anticipate what the amounts will be, as they simply depend on engineering works. For the last years, for the last periods, those capitalized costs were pretty much comparable year over year. In 2015, more of those expenditure were capitalized as we simply reached the levels of lignite that will be consumed for a longer term. I would then expect that 2016 will not be as beneficial as we had in 2015, but as said, that very much depends on engineering works.
About this capitalizing. On the page 33, you can see the capitalized cost in the EBITDA bridge rose 500 million in conventional generation from 1 billion, from 860. So it's quite a huge amount, and it really impacts the dividend potential of the company of this one account. So I'd really like to understand what is the future of this account, and if we can see 500 million lower EBITDA next year just because of it.
Cost capitalization improves EBITDA as the cost borne in a given year are then carried forward to the next periods and expensed in the next periods in the form of amortization, depreciation. So I'm not sure I got your question right. You would usually see the 800 million of the capitalized cost in 2015 as an expense if all of what you extract is used in the same period.
Yes, but in 2016, can I see like only 500 million of capitalized cost? Is it possible?
As said, as I responded previously, that very much depends on engineering works and schedules. I wouldn't expect another 2015 going forward as a larger portion of those operational expenses was capitalized.
So, given the generation, conventional generation segment outlook, is there a room for further write-offs?
As we also commented for the half year, we analyze the quality of our assets and the quality of cash flows going forward on a regular basis. We analyzed those for half year, and an impairment charge was accounted for. We analyzed those for the full year, and no additional impairment was recognized. As such, we believe the current base value of our assets reflect the future cash flow potential of those assets.
Thanks.
Well, it seems that our guests in the room utilized all the questions the internet viewers asked. So thank you all for joining us for this presentation. We'll see you in May for the Q1 results. Thank you very much.
Thank you.